And now, an Envision Financial podcast with Luke Smith on Canberra's 2CC.
Yes, it's time once again to welcome to the studio from Envision Financial, Luke Smith. Good afternoon.
Good afternoon.
Well, today we have on our agenda at the top of the page how to use shares and exchange-traded funds together in a portfolio. Now, exchange-traded funds just are packages of shares, aren't they?
Spot on. Exactly right. And I think that's part of today's conversation is just sort of demystifying some of the assumptions and misconceptions of how you can create something and how you can use different types of investments for different things. So if we start by saying, okay, what do I want to look for in a share? You want to think about, why am I buying it? So a big misconception is that all shares pay huge dividends. No.
No, some of them pay none at all.
Exactly right. And some shares provide huge capital gain. Not the case.
No, some of them go backwards.
Spot on. So when we start with how am I going to create my portfolio and what am I going to use, some of the things that you want to think about in relation to looking at a share is, what sector is it in? What sort of earnings does it generate? What's its payout ratio? So that is the proportion of its earnings that it will distribute as a dividend to investors. Some companies have a really high payout ratio, and traditionally banks and the likes of a Telstra have paid out 70 to 75% of their earnings. Other companies pay out a lower percentage of their earnings. So again, don't make an assumption that they're all the same. If you're going to put something into your portfolio, you want to start with, what is it going to do? And I use a car analogy a lot in my office because I find people can get it. And I say regularly, a Mini's not going to pull a horse float. Now, we could apply that to this scenario and say that CSL or Cochlear, okay, two massively wonderful companies, are not high income payers. They have in the past provided wonderful growth. So if you're looking for a long-term growth stock in the medical space, there's two examples, but they're for growth. If you want something that pays dividends, then you need to look at something that has a relatively high payout ratio and some strong reoccurring earnings growth, because that will get you a greater proportion of your return as a dividend. And that's why traditionally people have always liked bank stocks, because they provide some growth over time, hopefully, and they provide some ongoing income distributions so that that income can then underpin pension payments in retirement. So it's important that you think about what you're going to get from the stock, what area the stock is actually trading in, what's its core competency. Does it have a strong balance sheet? Does it have a good payout ratio? And is it well run? They would be the sort of key things that I would look at. The last part to that would be, does it provide fully franked or partially franked income? Now, all that means is that with a fully franked stock like CBA, they provide you with a tax credit for the tax that they've paid. And franking credits were introduced many, many years ago in the 80s to give people incentive to invest locally, and you get your dividend and then you get a franking credit, which is tax paid by CBA in this example, that helps towards mitigate some of the tax in your own name, in your trust, or in your super fund. And the wonderful thing about franking credits in pension phase is that the cash, the franking credit equivalent comes back to you as cash from the ATO. So they're wonderfully, wonderfully powerful. But again, don't assume that everybody pays a fully franked dividend. CBA does. Macquarie doesn't. It's partially franked. So you get some of the franking credits, which is in true Macquarie style of giving you a little bit, but not everything, because they've just got a history of just being difficult. But that's a whole nother show.
Well, they have shown pretty solid price growth over the years.
Oh, look, as a shareholder, wonderful. As someone that uses them, I'd rather chew broken Corona bottles. But again, that's a story for another day. So look at the franking credit profile of what you're going to buy. So when we've gone out and picked our stocks, that then brings us to, well, how can an ETF or an exchange traded fund complement what we've bought in relation to the shares that we have? Because people have favourites. You know, somebody might like healthcare, they might like tech, they might like banking, they might like a certain stock for a certain reason, and that's great. ETFs then come in as the diversifier around individual holdings. And you were spot on at the start of the show. An ETF is just a collection of individual shares. And that is exactly what it is. So we apply the same lens to the ETF. Where do they invest? What do they invest in? Do I get a good dividend? What location or sector are they targeting? Because you can get an ETF in just about anything. And they are a wonderful, wonderful, cost-effective tool to be able to say, okay, I don't want to go outside of these 3 bank stocks, but I know I need to have an exposure to the broader Australian market. So you might buy, your 2 or 3 bank stocks and a BHP, great. And then you might have an ETF that invests in the ASX 200 biggest companies or the ASX 300 biggest companies. You can dial it right down into the top 20, the top 50. So an ETF just replicates a specific index or portion of the market. And they are so tailored these days that you can really start to dissect, especially in some sectors, into the area of the market you want, a specific collection of holdings, a specific location geographically. You can provide unhedged or hedged exposures, which just eliminates currency movements. You can purchase the S&P 500 index in America, and I know one particular ETF will let you maintain that exposure, and the cost to use that investment is 0.04%. Now, if you look at your superannuation 2024 statement, you'll see the investments that you're in. And if you're in the balanced option, the growth option, all of those options have a cost. And that cost is known as the internal cost ratio. It's the charge that you pay for being able to use that particular investment in your portfolio. Now, ETFs are absolutely fantastic at being very, very lean, well-run machines. As I said, you can buy the S&P 500 for 0.04%. When you think the most balanced funds, for some context, most balanced funds in a super fund would charge anything from 0.5 to 0.9, depending on what you're in. So at 0.04, that is very, very cheap. You can buy the ASX 200 from different providers at anywhere between 0.07% to 0.15. And again, a lot cheaper than 0.5 or 0.8. So ETFs are wonderfully cheap. They give great diversification, and they allow you to target different parts of the same market. So what I mean by that is you can have an indexed weight ETF, which takes the largest stock in the index. Let's take the ASX 200. It takes number 1 and it comes down to number 200 on the size of the shares in the market. You can have an equal weight ETF that says, right, we've got 200 investments in this ETF and we're going to hold 1.5% of all of them. So again, delve into how the ETF is structured, delve into the market that it invests in, consider the way that it maintains that exposure, and then look at the income profile and the franking credits that could be available, because an ETF in the local market will provide franking credits. International ETFs and international assets generally don't, but ETFs in the international space are really, really good because you might not want to hedge all of your international investments on Microsoft or Google or Johnson & Johnson. But you could go and buy the S&P 500, you could go and buy a world index, you could go and buy an ETF that invests in everywhere but America. So again, you're trying to diversify your portfolio by bringing together different ETFs that target different markets to maintain that theme of lots of eggs in lots of baskets. So an ETF and a share can work really well together. You just want to make sure that you're not doubling and tripling up on the same exposure to the underlying investments where you do have high quality shares in your portfolio.
Yeah, you used as an example before, pardon me, you used as an example before the case where somebody might have 3 of the big 4 banks and BHP. Now that's 4 very big, very well established companies that are showing consistent results over a very long period of time.
Yep.
But if you already hold those, then are you saying that you should look for an ETF that steers away from those particular investments and focuses elsewhere?
Well, potentially, but just be mindful that you may not need to buy those particular shares if you've got a high concentration of them in the ETF that you use. And a good example of that sort of combination could be you might hold those bank stocks. Then you might hold an equal weight ETF that has a smaller allocation to each underlying asset, because CBA being one of the largest shares on our market, it will make up a very large proportion of a standard index ETF because of the number of shares that are available and the value of those shares. Whereas an equal weight ETF would give you less of an exposure to those same assets that you hold directly and potentially further diversify what you have. You can also, in that example, say, well, I want to buy an ETF that excludes the top 20 stocks. So it starts from 21 onwards, or the top 50 gets excluded. So again, you're diversifying away from what you have directly, and you're getting a greater spread of assets in the same area, but just not to the exact same holding. So that's why understanding how the ETF is structured is really important, because you don't want to have 7 or 8 of the same thing. And that's one of the challenges that we face in the international space, because it is so tech heavy. Any of the indexes are going to have a fairly large weighting to them because they need to replicate that index. Because if they don't, and a particular asset in that area rallies very strongly, they'll underperform their peers, and then people will get upset. So there's a little bit of science to it. But again, I think if you can always get a good summary of what the underlying providers are, and also shop around your providers. So 20 years ago, there were a few providers. Now there are loads and loads and loads of different providers, and you can go to some very high quality companies like Vanguard, BlackRock, Beta Shares. Beta Shares will put an ETF together with 2 cockroaches running up a wall. Like, they've got an ETF for just about anything you could possibly want to invest in, because that market is always evolving. You can also use an ETF to get a geared exposure to a market where they internally gear the ETF so that you don't have to go and do the borrowing, where traditionally, say, you'd pulled 100 grand out against the house and put that into the market for a gearing effect. You can get that now inside domestic and international ETFs, and they do it all for you as part of their service offering. So just know what you're buying.
The other thing that occurs to me, we haven't actually clarified at this point so far in our discussion today, is for people that may not know, exchange-traded funds are very easy to access because, as the name suggests, you just buy them on the share market like any other share. Correct,
that's exactly right. They are a listed vehicle. So as opposed to a managed fund that you go to the provider for and you fill out paperwork and you have to do all of that, you can go on the ASX with your trading account or through your broker or through your super fund, and provided that the ETF is on the approved product list of your particular super fund, then you can go and buy that just like you would buy a CBA share or a BHP share or a Wesfarmers share. They are listed, they are liquid. You pay brokerage to buy it, you pay brokerage to sell it, and you pay a little bit in relation to the internal cost ratio to use it. Because, as you can appreciate, they've got to do a tax return, they've got to transact, they've got to do a raft of things to keep this thing going. So nothing's free, but they are very, very cost effective when you look at an Australian managed fund that might charge 0.9. If you could buy the ASX 200 for 0.15, that's an annual cost you're saving, which is very, very attractive.
It is indeed. Luke Smith from Envision Financial is with me in the studio today, and we're talking about how to use shares and exchange-traded funds together in your portfolio. We'll be back with more in just a moment. Luke Smith is with me in the studio today, and we're talking about how to use shares and exchange-traded funds together in your portfolio. So, Luke, we've covered quite a lot of territory already. What are the key things to remember?
Yeah, so the first thing is consider your overall asset allocation. So whether it's a share or an ETF, it will give you an exposure to part of a market. It might be Australian, it might be international, it might be fixed interest, it might be property. So understand the area that you're investing in. As we said before the ad break, understand what the share you're going to buy is providing you. Are you holding it for dividends? Are you holding it for growth? Are you holding it for franking credits? Are you holding it for capital appreciation? Are you holding it as a speculative tech stock that might explode? If you are, then don't expect massive dividends from it from an income perspective. So understand the characteristics of the share. Understand whether you are going to get a fully franked dividend, a partially franked dividend, or no franking, because that will affect the total return from an income perspective. So understand why you're buying something and what you're going to get from it. Make sure that from an ETF perspective that you buy things that allow you to get great diversification in a sector. So if you don't want to rely on a Google or a Microsoft or an Apple, then maybe buy an ETF in the US market. You can then delve really deeply into the international sector. For example, you might have the S&P 500, you might have the rest of the world, you might have a tech ETF, you might have an exposure to the NASDAQ, you might have exposure to global healthcare, you might have exposure to any area that you think is going to be relevant and long-term. It will work for you from an asset allocation and a growth perspective. So don't just think holistically. You can really start to get granular in different areas, like you can with the Australian market. If you hold a lot of big blue chip stocks, then maybe look at a mid-cap ETF or an equal weight ETF so that you're not doubling and tripling up the underlying holdings. Because if you've got 8 green apples, that's not really diversified because you've just got 8 of the same thing. More of the same is not diversity. So you want to try and make sure that you understand what the underlying ETF does, how does it provide its income, what is it exposed to, where is it domiciled, what's the growth outlook for it, what's the ongoing cost, does it complement the shares that I have. Think about index weight and equal weight because that can be a really great way to diversify. And then keep in mind over the top of that with the umbrella of how much risk am I taking on? So you can use ETFs to get an exposure in the fixed interest space. Like there are some wonderful ETFs that you can use that will provide a 5 and 6 and 7% income stream. And you can buy government bonds, you can buy corporate bonds, you can buy housing, you can buy a raft of different areas. And that's just 3 in the fixed interest space. So don't be frightened by them. They are very great diversifiers. They are very, very cost effective, so they're very cheap, so it keeps your portfolio running at a wholesale rate. Complement them with an area that you may not have the expertise in. You might be really good in the banking sector, but not know a lot about something else. ETFs are a great way to get an exposure to loads of underlying assets. You're not having to cherry pick the good and the bad, you get the entire index, which can take some pressure off the decisions that you make. So use them to complement each other and achieve the growth and the income profiles that you want in your portfolio.
So Luke, it's time to ask, where can listeners get more information?
Yeah, so office number 6260-4749. We've got envisionfinancial.com.au, that's Envision with an E, on the website. We've got the podcast, The Strategy Stacker, Luke Talks Money on iTunes and Spotify. And we've got Envision Financial Canberra. So if we can continue to have subscriptions to that, then we can look to try and get some additional guests in this year, which would be wonderful. And all of these types of things are in Smart Money Strategy, your ultimate guide to financial planning, in all good bookstores, all bad bookstores, and Amazon and online. So it's there for everybody.
And probably in some doctors' waiting rooms, you never know.
Possibly.
Luke, thanks very much.
See you next week.
We'll catch you again next Friday afternoon. Luke Smith from Envision Financial back again at the same time next Friday right here on 2CC.